CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund.
Hello and welcome to CNBC TV 18's Women and Money series presents Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. I'm Sumera Abdi. Well, today we'll be taking a deep dive into the world of mutual funds, both equity and debt funds, to try and understand, what are the different types, what are their advantages, disadvantages, tax treatment, and so on. So let me invite an expert to help us do that, Mrin Agarwal, who's the founder and director of FinSafe. Mrin, always good to see you. First, let's begin with equity funds because, that is the more popular category with retail investors. So, when somebody thinks of equity funds, the general tendency is to think that, maybe a large cap fund, a mid cap fund, at the very most, a small cap fund. But not a lot of people would know that even in this, there are 10 categories, right? So how does, one category differ from the other, and what are the various advantages, disadvantages?
The main thing that an investor needs to look at when they are trying to figure out the category is to first understand what is the risk that they want to take in a particular equity category. So obviously mid cap is going to be higher risk as compared to a large cap fund. So that's the first thing that they need to figure out, that are they willing to accept the volatility and the higher risks that is associated with certain funds, and based on their risk taking ability they can decide whether they want large or they want mid cap, or do they want a combination of these funds.
Okay, so any distinct, advantages that equity funds have, and also can you explain the tax treatment?
So as far as equity funds are concerned, they classify for short-term capital gains if you hold them for a period of less than a year, and they're taxed at 15%. And if you hold it for more than 1 year and the capital gain amount on a cumulative basis is more than 1 lakh rupees, then it is taxed at 10% and it classifies as a long-term capital gain. So that's what the taxation on equity funds is. The biggest advantage of the equity fund is that you can get access to Indian equities, and with a well diversified portfolio that is being professionally managed for you. And I think that's a huge advantage, and that's a good way to take exposure into Indian equities.
All right, so fair enough. Equity funds, therefore, being the ones that are investing in stocks. On the other hand, the other big category, and actually if you see by the assets which are controlled, debt is a much larger category than equity. Debt funds, of course, being the ones that invest in bonds. But here as well, Mrin, there are so many categories within debt funds that, it becomes very unnerving for an investor because, most of them are defined by duration. So can you give a sense of, what are the different kinds of debt funds and how can a person make the selection?
You need to tie in your investment in a debt fund along with your investment horizon and the fund's maturity. So, for example, when you look at periods above 3 years, you have funds like the short duration debt funds, you have corporate bond funds, credit risk funds, dynamic bond funds. And then, of course, you have government bond funds, which are known as gilt funds as well. You have longer duration funds like the medium duration and the longer duration funds. So essentially, you need to look at two aspects. One, how long can I invest my money for? And second, again, what is the sort of risk that I can take? So let us say that you can hold for a period of 3 to 4 years. Your options then are based on lower risk. You could go for a short duration or a corporate bond fund. If you're willing to take higher risk, then of course it would be a credit risk fund or a dynamic bond fund or some of the longer duration funds. So this is the way. There are two things that you need to always look at in a debt fund. What is the credit risk of the fund, which means is the fund holding good quality paper or is it lower quality paper? Because with lower quality paper, it would be higher risk. And what could be the interest rate risk on this particular fund?
Once somebody learns these distinctions, they start out to make their own portfolio. How do they know how much of equity, how much of debt can be added? Is 100 minus age still the most relevant formula?
No, in fact, I would not go with that. I would always say base it on your financial goals. But if you're not able to kind of do a real calculation, then the better way to think of it is that if I have 100 rupees today, how much am I willing to put at risk? Am I willing to put 30 rupees at risk? Am I willing to put 40 rupees at risk? And whatever that amount you're willing to put at risk is the percentage that you're going to allocate towards equity, and the balance is going to be towards debt.
Mrin, I was reading some statistic which suggested that, portfolios owned by women actually tended to perform better. So, with that at the back of my mind, I wanted to ask you about, how you have seen or what has been your experience with women investors, and, do you increasingly see a lot more women taking the plunge into managing their own money?
Well, certainly women are better investors because they tend to do a lot more research. When they also invest, they invest for the long term. So they typically tend not to trade on their investments, which of course is a good thing. And that's why you would see that women owned portfolios tend to do better. I do see more and more women getting into investing, and that's a good sign. But I think what is really required is for women to really educate themselves. There needs to be a lot more education, and there needs to be a lot more focus on the research that people need to do before they actually invest.
Uh, in terms of mutual funds as one of the tools, do you think, it's enough to meet goals like, say, retirement and even, say in the case of debt funds, would it be a better option than, say, a savings account, especially at a time when we are seeing negative real returns?
Oh, absolutely. I think it will be better than the savings account in the long term for sure. Even if you're looking at building an emergency fund, while it is recommended to keep some money in the savings account, certainly you should look at parking a portion of your money into some of the lower duration debt funds that I spoke about, simply because the returns are going to be better than what you'll get in the savings account. So certainly, yes, I think for most financial goals, whether it's retirement or it's children's education, I think the biggest benefit that you get with mutual funds is really the flexibility, right? So you have the flexibility, you have choices that are available, and you also have tax benefits that are available. So what could be better than that?
Mrin, can you also explain how a portfolio should age with the investor, right? I mean, how do you change your various allocations? And as you're nearing your goal, what is the checklist for you to start taking money out?
So, first and foremost, I would always say that uh, first, understand what is the right amount to be invested for a particular goal. There are a lot of goal calculators available online. Secondly, always tie in the product with the time to the goal. So, if the time to the goal is only 3 years, you cannot look at an equity fund for the same, right? So, look at tying in the product with the goal. I think it's important to evaluate the performance of your fund on a yearly basis and see how it's doing relative to other funds in the same category. Of course, you cannot look at your fund in isolation alone. You always need to look at performance on a relative basis. And when you're closer to the goal, certainly when you're nearing your goal, maybe a year before your goal, you need to check the value of your fund. And if it is close to the value of your goal, you need to look at exiting and investing that money in a safer fund or a safer instrument. And that's really to just protect its value. So, just to give an example, in March 2020, we had a lot of people who were very concerned about the fact that 5 year returns had become so low and they needed money for their goals. And exactly to prepare yourself for situations like this, you need to have, while you everybody has an entry strategy, you need to have the exit strategy in place too.
Like you said, that you should have every kind of strategy in place. Another strategy is also that, some people are either reviewing their portfolios on a daily, weekly basis, and then there are others who don't touch it for years altogether. So what is a good strategy in terms of, reviewing it to ensure that you're on the asset allocation path or your goal-based planning path that you have set out for? How often do you need to check your portfolio to ensure that you're staying the course?
I would say that do a more deep review once a year. It could be at the end of the calendar year. It could be at the end of the financial year. You can choose which period you want to do it in. But look at doing a good review at the end of the year to see how much of your goals have been met with your current investments. If there is any underperformance, and then of course you need to look at the reason. So the main thing is that just because you see some underperformance, don't exit the fund, because remember, all funds go through cycles. There will be periods of underperformance, there will be periods of overperformance. The point is to look at something that is consistently performing over the long term. So even if there is underperformance for a quarter or even for a couple of months, it's okay. You don't need to exit the fund right away. But I would say once a year is to do a review is a good thing.
Yeah, that's true. I mean, don't get too dejected by underperformance. Don't get too excited with outperformance, because both could be a little bit misleading at times. For example, I read this great study which showed that only 25% of the top quartile funds remained top quartile funds on a 3-year rolling return basis over a period of 20 years. So, not all winners are winners, and like Mrin said, it's the consistent performers which are always a better choice. But, Mrin, this whole question of choice is another very daunting task. I mean, we do realize that there are so many categories which have been created to facilitate, the right fit into investors' portfolios. But then in a case where we have 44, 45 AMCs and, so many categories, what results eventually is that we have 2,000 plus schemes. How can you narrow it down from, say, 2,000 plus to 5 or 6 which you actually need in your portfolio?
Yes, Sumera, and this is one of the biggest issues that investors have, that they find choosing a fund very difficult. So here are a few steps. First and foremost, decide on the category based on the time to the goal. So shorter term, debt funds; longer term, equity funds; medium term, let's say balance funds. Second thing is that within the category, based on the risk you want to take, you can look at the subcategories. And just to make it easier, I think for equity funds, the main categories that you can consider are index funds, flexi cap funds, and mid cap funds. Honestly, a combination of these three should be good enough for anybody's portfolio. So look at the subcategory, and then when it really comes to the scheme selection, while it's easy for us to say that look at consistently performing funds over the long term as one of the parameters to really get this information, like, for example, to get rolling returns data is not very easy. So I think, one of the things that people can look at is websites that don't have any vested interest in showing particular funds. And there are a couple of them, like you do have some research websites and all that are available. I think Money Control also has a list of funds called MC30. So you can look at a couple of these resources to figure out which fund to invest into.
All right, Mrin, that's good advice. Thanks very much for joining in and for explaining the basics of investing into mutual funds. Thanks very much for joining in, and for everybody who's been watching, I hope you found this helpful, and I hope you have a very, very happy and financially prudent new year.
CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.